Welcome back. Nathan gave us the drum roll, the silent drum roll, so that none of you could hear. So, welcome back to Vetted VA Live. We are actually here on week 7. Every week we get together here and pick important topics that you guys are asking about in the Vetted VA forums. And we go through live answers with experts, vetted experts from around the country, mortgage loan officers, and realtors. So, this week we had a late minute cancellation, which got us a special guest, Nathan Nottingham, the COO of Vetted VA, is going to be here to join us. And he brought his guitar. He may play and then give us some musical accompaniment in the background.
Yeah.
We also have
That's
Sam
a no.
Rubin.
That's a no. By
No, you're not going to do it?
No.
All right. Well, we have Sam Rubin, a realtor from Richardson, Texas. And we also have Tom Mancuso, a mortgage loan officer, works with AmeriFund Home Loans, one of our friends and other vetted experts here. Jamie Kavanaugh is president over there at AmeriFund Loans. I didn't know, Tom, you were with her until you had mentioned that. So what we're going to be talking about tonight is a big source of confusion that we get a lot in the forums that the moderators are going through and answering all of the time. What goes into my escrow impound account? Do I have to have them? Why are my closing costs so high? Well, is it a closing cost? What is it? So we'll go through a bunch of those questions. But before we do that, Sam, why don't you tell us a little bit about yourself, your history to helping Texans buy homes and your journey here to Vetted VA?
I am a 13-year Army veteran, and I have been with Vetted VA for the past 3 years. Been doing real estate for the past 8 years, and just love teaching and helping our fellow veterans through the VA process and understanding Texas laws when it comes to mortgages and taxes.
And that's a pretty common theme. We, Nathan, what, in 7 weeks of asking 20 something experts, everyone got here because they love to help and they love to teach. You almost have to have that heart to serve to be here and moderate. There's some tricky questions and a lot of questions that pop up in the forum. Tom, how about yourself? How did you get into the mortgage business and how did you find your way over here to Vetted VA?
I started in finance at a young age, followed my father into this industry, at least the finance industry. Was in automotive finance for a number of years, for about 15 years. And a couple of years ago, got the opportunity to come in the mortgage business. And so that is definitely a passion to me. My father, the one I did follow into the finance industry, was a Vietnam veteran. My grandfather was a World War II veteran. So it's very important to me to give back to those that serve this country, just like those men and women.
Awesome. Well, we're happy to have both of you here. And with that, why don't we jump into the discussion? And because it's a little bit more on the mortgage side, because we set this up when we're doing the loan. But Tom, tell us, what is an escrow impound account?
So an escrow account is almost like a third-party savings account. It's managed by an independent third party, and they basically will hold funds and disperse funds for property taxes and homeowners insurance, at least on a VA loan. Now, a VA loan does not carry mortgage insurance. So unlike a conventional or FHA loan that may contain would contain mortgage insurance, a VA loan, that's not part of it. So they'll only disperse property taxes and homeowners insurance if you do not waive that, meaning you did not waive the escrow account. There are some situations where you can only impound or have escrow contain maybe only the property taxes or only the homeowners insurance, or you can have both of them included. So if the principal and interest payment on a mortgage is $2,000 a month, that is the principal for the loan and the interest for the loan. That does not include the homeowner's insurance or the taxes. So you hear veterans say, or buyers say, hey, I thought my payment was going to be X amount. Now this $2,000 payment's going up to $2,500. What is the increase for? The increase is for monthly. Your taxes and your insurance, if included in escrow, will be paid, meaning every 6 months or annually. You're not going to get a separate bill for your county to pay your property taxes. Also not going to get a separate bill annually for your insurance to be renewed. You have to pay that out of pocket. So when you see that mortgage payment, including escrow, taxes and insurance, principal and interest, that is the amount of your payment each month. That includes your taxes and insurance. So that is how an escrow account works. Again, it is a third-party account, like a savings account that is managed separately to contain that information.
You know, and there's a lot of misunderstanding around it, a lot of positive feelings, a lot of negative feelings. I think I'm older than most of you guys, but one of the sources of frustration as an originator in late 90s, early 2000s, going back to the good faith estimate era, is people loved to hide the peanut of the taxes and insurance and tell people what it was. Now, you know, if you go back to episode 1 that we did here, we went through and did a complete breakdown of the loan estimate, and that loan estimate showing you what your taxes and insurance are going to be, and even also showing you an HOA if you're going to have it, because it just wasn't getting disclosed properly. So we can talk a lot in negative ways about government regulations and new forms and everything they throw at us, but it is a good and positive thing. Sam, from your end, what kind of feedback do you get from clients on the VA loan? The vast majority of lenders are going to require the impound account, but when you have buyers, do they appreciate it, or do you have some of them that want to be responsible and lone wolf and take care of it themselves?
Oh, great question. The majority of my buyers that are financially responsible throughout the year don't mind not having the escrows added. But your traditional everyday buyers, which is the majority of the buyers out here, they typically want to add it, especially in Texas. Our property taxes eat up a nice chunk of our mortgage. So don't, you know, at the end of the year, somebody might have $12,000 due to the state of Texas for property taxes, and they don't want to come up off that money at one time. So it's kind of went both ways, but the majority would prefer for it to come out monthly, so they don't have to think about it at the end of the year, or the first of the year, right after Christmas and all of the holidays, having to pay $12,000 to the state of Texas.
Yes, amen to that.
Yeah, the tax bill, especially in states. So in Texas, you guys only pay once a year?
Yes, we pay ours out once a year.
It's a high property tax rate. You have some more affordable homes, but more expensive homes in Texas, but a big tax rate, and once a year. So for us in California, it's twice a year. Our tax rate is a little bit lower, but we have some very expensive homes. But I would be a little scared at the thought of seeing a tax bill one time a year as big as those would be. Tom, let's talk a little bit about something of a misconception is out there. We talked about the vast majority of lenders do require that with the VA loan you have an impound account. Is that a VA requirement, and do all lenders require it?
So it is not a VA requirement, and some lenders do not require an escrow account on a VA loan. So it is important to find out. You hear the term when we throw this out, a lot of our professionals throw this out, lender overlay. In layman's terms, what does that mean? Okay, that basically means you have your set of VA guidelines. They're published by the VA. Veterans Administration lists the guidelines, thousands of pages of that. You'll hear us pros refer to that many times. But then you'll also hear, what about lender overlays? Lender overlay is a particular lender, a mortgage lender, that may have additional guidelines over, well above and beyond a normal VA guideline. And so that lender overlay might be VA loans must contain an escrow account. They must have taxes and insurance included in escrow. That lender overlay will supersede what the VA guideline says. Therefore, that particular lender will require that. But lender BYZ may not require that. They might not have an overlay. Therefore, they just underwrite to VA guidelines. What's in writing by the VA is what is set in stone. They do not have any additional overlay guidelines over that. And so that is a very important thing to check with your lender, check with your loan officer. Hey, does this lender we're going to place my loan with, do they have any VA overlays? Do they have any lender overlays? What are those lender overlays? I'd like to be aware of that. Some loan officers can shop lenders. They can go to different lenders. A broker, even a retail organization might have different options. Those are all things that you want to ask. Those are things that we want to talk about with our loan officer. We want to get an understanding. There's nothing wrong with that, because as Sam and Josh, you guys were just talking about, Nathan, I don't want a $12,000 bill once a year. Arizona, we do it every 6 months. And actually, our tax rate is even less than California. it's actually very, very reasonable for property taxes. At the same time, we don't give veterans, a disabled veteran or an active duty veteran, any exemption from that. So we're working on that. Vetted VA, we are working on that because that needs to change. But
Yeah.
even though the tax rate's not very high, I still don't want a bill for $1,000 or a couple $1,000 every 6 months. We get it every 6 months here in Arizona, similar, like we were saying, Josh, to California. It is a lower tax rate. But the lender overlay is something you definitely want to have a conversation with your loan officer about, because we'll tell you they don't stop at escrow accounts. I know that's the purpose of our call tonight, but lender overlays on VA loans can go well above and beyond just an escrow account. So you want to get into these things with your loan officer, because these are things you may have a friend who's a veteran. They didn't have to have any of these problems. They waived their tax and insurance. Why are you being penalized having to include your tax and insurance? Might have nothing to do with you as the borrower. Might simply be the lender that your loan is going to be placed with that is doing this.
And Tom, one of the things that's amazing is a lender talking to a borrower when they hit a roadblock that they have an overlay that's going to be a problem for that borrower. I don't know about you guys. I have yet to hear the borrower call me and say, hey, this lender said they have an overlay. They tell me, hey, this lender says the VA won't allow this. One of the more famous giant call centers in the VA industry is a 45 max DTI. They don't say we have a 45% max DTI. They say the VA has a max 45% DTI. So if you have questions, and it's funny, one of the things in my business partner built a big website very similar to Vetted VA, a blog way back in the WordPress days. So we get a lot of these questions, and a lot of the same type of people that would show up there show up to Vetted VA, in that they're truth seekers. They're like, something doesn't sound quite right. So they show up here, they ask Sam, they ask Tom, they ask whoever is moderating that day, and dig to the answers. So kind of going a little bit deeper, one of, again, the big, it's not a misconception, it's almost a misunderstanding. You guys, probably every moderation day that you're working, someone says, hey, I have $17,000 in closing costs. That sounds really high. So we want to talk a little bit about what's prepaids, what's closing costs. So when we talk about prepaids, a lot of what is establishing that escrow impound account is a prepaid expense. It's not a closing cost. So the difference there being that the closing cost is a non-recurring. You pay it because escrow, title, you're buying a home. The impound account is insurance, property taxes, things that are going to be ongoing. Do either of you kind of want to walk us through what that looks like of how we determine how much needs to be collected at closing for establishing that impound account, and why it's different than closing costs? That's not an amount that your lender's making that they're putting in their pocket.
Yeah, actually, I'd be happy to. Is on a loan estimate, which is the federal 3-page document, also used to be called a GFE, good faith estimate. They're called a loan estimate now. So you want to get a loan estimate from your loan officer. And the reason why I say loan estimate is it's not a fee sheet. It's not a lender generated document. It is a standard federal document that goes over interest rate, payments, fees, closing costs, lender fees, third party fees, like the VA funding fee. All of those things are itemized on this form. And also on this form, you're going to see a section that says prepaid, and then you're going to see another section that said escrow. And so basically what this is doing is the prepaid amount of your insurance and your taxes is a certain amount that's put into that account to basically kickstart the account, right? So they're seeing that money in there. It's a base. Then they're going to have the separate section for the escrow amounts. And so there's going to be a couple more months of taxes, a couple more months of insurance, because again, we're talking about the whole reason that an escrow account is nice is because it avoids a bill that you get in the middle of the year. Well, guess what? If there's not enough funds in your escrow account for your taxes and insurance, you're going to get a bill for a shortage, an escrow shortage, which is basically you having to pay more money into that escrow account. So each month when you make that payment, there's enough tax and insurance money in there. And so it is very important to look at these numbers. And even though the loan officer and the agent, we don't control these numbers, it's important to have this discussion with your loan officer. Because number one, these numbers can change. like on a refinance, the number of months of insurance that are required is dictated not only by when your insurance renews, but it's also dictated by when you close on that loan, what month of the year you close on that loan. So even though the loan officer doesn't control those numbers, the loan officer is aware of those things. And these things can be manipulated to look less, like Josh is talking about. They're lumped in with your closing costs, but technically they're not the same as a closing cost, like an appraisal fee or a title fee. They're not exactly the same because they are recurring amounts. So it's important to talk with these things about with your loan officer, because also, like Sam is talking about, taxes are due once a year in Texas. Now, I'm not licensed in Texas, but I bet you the loan estimate for a Texas purchase, because the taxes are due once a year, are going to be calculated different than in Arizona, where they're collected twice a year. So if the taxes are collected in March and October in Arizona, and I'm buying the house in May, well, I should only have to pay the remainder of the property tax that's due. The seller should have paid a portion of those taxes up until when I'm taking ownership of that property. So every 6 months they're paid. But Sam, like we're talking about in Texas, they're paid once every 12 months. So they're going to be calculated different. Now, if I'm a veteran and I'm a buyer and I'm moving from Arizona to Texas, and I'm familiar with how they work in Arizona, but I am moving to Texas and I look at my loan estimate, why on God's green earth would 10 months be collected of property tax when in Arizona it was 6 or less? That doesn't make sense to me. Again, we want to go through these things with our loan officer. The only dumb question is the one that's not asked. So we can't assume anything. And while we as loan officers, professionals, real estate agents, we try to do our due diligence and go through all these things, there's still sometimes we take things for granted and we miss explaining these things. So it's very important to understand why these things are different. On a purchase, for instance, you're going to have a full year prepaid homeowners insurance calculated in that loan estimate. Then you're also going to have probably about 3 months put up for the actual escrow account. Well, why is that? Well, the lender wants 1 full year of insurance prepaid. They know for 1 full year, 1 full policy is paid for on that home. So for the full year, they're covered on insurance. They've got a couple extra months as a cushion for those mortgage payments to be made, including the homeowner's insurance. So that's just one of the things that'll be different. Again, a purchase is going to be different than an actual refinance, because the refinance is already insurance on the home. You already own the home. Purchase, different situation, new lender, new owner, a whole new mortgage on that home.
So Sam, I'm curious, Josh. I'm going to interrupt here because I wanted Sam to weigh in a little bit. As an agent, Sam, you handled a ton of transactions last year. You do a lot of transactions in Texas, especially. There's been a big move into Texas, a net gain overall. I personally am one of those too, right? I came out of Washington State, and we paid biannually our taxes, and I came out of Oregon, which was paid annually. So I had been in both situations. How do you prep the buyer when they're looking at houses? And here's the thing that threw me: the homestead exemption. That one just tossed me, and I just got hammered with it. I want to talk about it a little bit later, but how do you prep your buyers, even if the loan officer doesn't necessarily, maybe they're not located in Texas and they don't know how to prepare the buyer? How do you prepare them?
Well, that's a very good question, because I've had plenty of buyers that do come from me from out of state, and they have a lender that is licensed in Texas but has no clue about how our property taxes work. And for instance, just recently I had a client come to me. They were looking in the Fort Worth area. They were saying, oh, we're going to buy a $350,000 house, and they thought their monthly payment was going to be $1,400. And I was like, does that include the property taxes?
That was the property taxes, right, Sam?
I was like, that doesn't sound right. I said, send me over the document that he sent you showing that, because I can pretty much tell you that's not accurate. And so they sent it over to me. I said, he had like $150 for property taxes. I was like, no. I was like, you're going to cry, because $350 is not your range once we update this. So I sent the loan officer a PDF file from the Texas, we have what's called county websites. So we go to the specific county that it's in, we pull the tax information, the previous tax year's information, and I sent that over to the lender, and he updated their amount. And they was like, oh, wow, this is not what we were expecting. I said, exactly. I said, so that's kind of how I counteract. I try to make sure, where is your budget going to be? Do you know that budget includes our property taxes, which on average at a minimum is about $500 a month? And of course can go higher. So I kind of work with them on that to make sure that they know, like, this is, we have PDFs that we send them for different counties that says this is what the current property tax rate is. So that's how I assist my clients with making sure that they know this is the property taxes if you do have to pay it.
So Sam, you just gave us a really good view of the property tax side of it. Tom, you gave a really good example of the insurance. And for a VA loan, they're almost the simplest of these because we have no mortgage insurance. Those are really the only two things they're going to go into that impound account. So I kind of want to just back up and give a simple recap and then ask you guys a little bit more specific question on that. So on a purchase, Tom, you said you're going to pay the first year's premium, and you're going to put in about 3 months to seed that account for the renewal. Now, if it's a refinance, it's going to vary depending on how many months are left in the year. You don't have that 12 months. It could be if you're close to due to renewal, but you're going to have an adjustable amount, a variable amount, and then again, that 3 months. Now, the property taxes, Sam's in Texas, Tom's in Arizona, I'm in California. We got people in all 47 states, and unfortunately, they all handle it differently, both in terms of rates and times that they're paid. So I'll chime in towards the end of what California looks like. But Sam, with Texas and many states, I would probably say, would you guys agree with the majority of states are more of the once versus twice a year? But if they're doing it once a year, how does it work between your seller having paid taxes and a proration back to them versus what we need to collect from the buyer to make sure we have enough in the account? And then here, I got a follow up to that for you once we go through that.
So in the state of Texas, we pay our taxes in arrears. So basically, whatever the current tax value is for the year that they assess it, that's what's paid. So unfortunately, if the taxes do come a little bit over what is stated on the tax statement that the title company receives, the buyer is responsible for the overage. So if let's just say we close on June 30th, the buyer will be responsible from June 30th through December 31st of that current year. The seller will be responsible from January 1st to June 30th. So there is a way to it involves a lawyer, but there is a way to kind of request that the sellers give a little bit more than what the tax statement says. But you have to hire a lawyer to have them add that verbiage into the contract and make sure title company does what they're supposed to do to kind of have the sellers cover that overage. But 99% of the time, it's not going to happen. They do it exactly like that. It's prorated January the 1st through whatever day to close, and whatever day to close to the end of the year, and the buyer's responsible for that small of a portion.
Got it. So another thing, we've seen a rapidly appreciating market the last couple of years, especially markets like Texas, people moving out there and with the taxes paid in arrears. So Nathan moves from Washington to Texas. He buys a home with a nice low tax assessed value and his high tax rate in Texas. Tell us a little, this isn't specifically escrow impound account related, but it does impact things going forward. Tell us what happens when Nathan finds out, great news, my house went up $100,000 in value. Bad news, my assessment also shot up. Well, what happens to
it's worse than that, and I'm going to ask Sam to clarify this for me, because this is the experience I had, right? So I'm moving to Texas. Woohoo! I was super excited. Got my acres. I had my I knew enough to even look at tax rolls, past tax rolls, assuming growth. Did my own calculations of what I thought was going to happen. Didn't understand homestead exemption, and didn't understand what homestead exemption did to cap the growth in the past. So my calculation was wrong from day one. And when I bought the property, it lifted that cap until I've been here a year and my homestead exemption goes back into play. And I was like, I saw my bill. I'm actually looking, I pulled it up just for this call, so I'd be hot, ready to talk about this. I'm super hot. I want to talk about this thing. But this was shocking to me. And I'm okay now. But That threw me off, Sam. I didn't even think to ask this question. And so it's really important with every state you go into, you have to ask the question on the property tax that you're looking at, is there any kind of exemption or cap on the growth of this property? Because what happened is once it changed hands to my hands, the county literally said, hey, by the way, we value your property. Actually, now, just a few months later, their tax valuation is higher than what I bought it for. And I think I have gained a lot of equity position in the market. But there was no limiter on how much that tax valuation grew. So I'm now up to full capacity until my exemption comes into play. And that was a big shock.
So so first I want to answer the question. So in regards to exemptions, we have multiple exemptions here in Texas. We have 65 and older. We have disabled veteran. We have homestead exemption. Everybody qualifies for the homestead exemption if your ID has your property address on it. If your property address does not have your primary residence, which is the property that you purchase, you will not get this exemption. I don't care whether you military or whatever, your property address has to be on your current ID. And ID has to be valid for them to give you that exemption. So everybody qualifies for it. The good news is, Nathan, as of this year, you're able to file that exemption immediately once you own the property. You don't have to wait anymore. So now you can go into the year with an exemption on it instead of waiting until the next year to roll it in. If somebody already has that exemption, then the tax servicer, they will give the person that's buying that property that exemption. So whatever their taxes were for that year, that's what they get. If somebody over the age of 65 is exempt from property taxes, meaning there's no taxes paid, then the title company will have to assess what the new person's taxes will be, and then guesstimate what that person is paying. So exemptions are definitely important when you're looking at buying a house. You want to make sure that if there are exemptions, do you qualify for those same exemptions? If you don't, make sure that the lender accounts for the difference that you do not qualify for. Yeah.
Wait a minute. So is that a 2022 change or is that a 2021 change? Because I'm about to go write a letter to my
2022 change. So as of today, you can file your exemption.
No, I already filed. I filed for it, but it doesn't go into effect because I bought it in 2021.
So we could use hypothetical numbers, or we could use Nathan's actual numbers. in Texas, let's say someone bought last year and they bought a $250,000 house, and like Nathan says, the assessor goes, "Well, cool, it's worth $325 now." When that next tax bill comes due, how does the protections of the exemptions work? How could it or should it have worked for Nathan?
So the thing with Texas is your property tax value is separate from your appraisal value. So any event that you bought the home, let's say you bought the home for $250,000, but they're assessing your property at $350,000. You will go to the county and you'll say, "No, here's my appraisal. This house is only worth XYZ." You always want the value to be less on the tax appraisal website than what your true cost is. So if you bought the house at $450,000 and they're assessing it at $325,000, great. Don't do anything unless you know that you can get that value down. You can protest property taxes in Texas. There's multiple ways to do it. I wouldn't recommend paying anybody because it ain't guaranteed that they're going to win for you. I protested my own once before. I won't do it this year because I'm sitting on 100K plus, and they ain't calculating it. So, so I will not be protesting. Thank you, Dallas. But so you can protest your property taxes in Texas to kind of combat what the county is saying. And I do recommend reaching out to your realtor or any realtor in the state and say, "Hey, can you tell me what my true value is based off of XYZ? And if that value comes in above what the tax person says it is, then leave it be unless you can get it down a little bit more. If it comes in less than, you definitely want to fight that and submit the evidence and say, "Hey, no, based off of the true appraisal or true comparables in my neighborhood, my house is not worth what you're taxing me on." So that way you can get that discount that the exemption is supposed to help with.
Nathan, we have a very important question from the audience. Did you protest your taxes? And if so, what was the result?
I totally did. In fact, I went through the process and I protested, and I was just looking at it. So one of the things that I think I didn't understand, and I'm saying I didn't understand, I've been licensed in mortgages since 2008. I haven't always been active, right? So I've been around this industry for a while. The transition, I did receive in my 2022 proposal, I received the homestead exemption. It is in the calculation. What I didn't receive was the cap on valuation increase. So my valuation, that 10% cap where your increase can't go above 10%, that was removed. So where this property was kind of floating around the last 6 years and never going more than 10% increase in value as part of the it's part of the cap on the tax increase there, that was ripped off. So that's where I saw a 75% increase from what I thought the tax valuation was going to be to when it came in. And it came in, Sam, I'm kind of with you. I'm not going to go ask him to readjust that because I don't want him to dig deeper into what 10 acres looks like out here near the lake. Like, please don't look at this, Mr. Taxman, right? Like, just stay away. I'm just going to be okay. I went in and I did, and this is what I think is important for anybody in any state. When you don't think your taxes are right, don't just sit there and take it. You actually are dealing with, as a landowner, a mortgager, or a trustee holder, you are actually you need to have your voice heard in the public court of opinion on this one, because this is a tax issue. So if you're seeing something that you don't think is quite right, you need to go through the process. In Texas, it's very easy. I had to learn all this myself this year. There is a online protest. You go in, you sign up, you say, what are you protesting? And I'm protesting that this transition that I saw didn't look fair to me. I thought that they had misvalued it. I didn't really understand what I was looking at until later, and I went, okay, I see what's going on here. But the protest didn't hurt me, and actually I found it to be very educational. And so that's one thing too. I think that, and we should talk about insurance, but I think that taxes, here we are, I budgeted for this payment. My interest rate hasn't changed. It's 30-year fixed. My mortgage, my principal hasn't changed other than going down just a little bit, right? As I'm starting to make my payments, I'm paying my interest, and all of a sudden my payment on my house is just adjusted by $400 a month. Ooh, that was a hard hit, right? That's a pill. And you're like, wait, why? Well, taxes. So there's only two things you can do. You can not pay your taxes, and that's not a good idea because that'll lose your house real quick.
Very bad idea.
So pay your taxes. And the two is to prepare to pay your taxes. One thing I'm going to do, now that I see this happening, when this becomes official after the date and they certify this new assessment on me, I'm actually going to send it to my servicer ahead of time and say, my taxes are going up. We need to adjust my payment now. And so we need to talk about RESPA Section 10 probably in this conversation, but I'm going to tell my servicer ahead of time, like, please adjust my payment now so that come January 31, when that bill's due, they're not asking me for X amount of thousands of dollars that they had to pay on my behalf and now I owe them. Like, that'd be horrible.
Well, Nathan,
I wanted to add, that brings up an important thing. As we talk about, like Josh said, every state's different. We're talking a lot about Texas because obviously Nathan and Sam are in Texas.
Because I'm passionate.
Yeah, no.
Because everyone's moving to Texas.
This is a good example. A lot of people are moving to Arizona too. And one of the things that I've recently learned is some states, California being one of them, they automatically reassess after a sale is closed, where some states, Arizona, we don't do that. And I actually had a lender that was unsure of that because the lender is based in California. The lender says, oh, they're going to reassess. This home has gone up so much in value. I said, actually, Arizona doesn't reassess after a sale. So they were trying to preemptive raise the tax amount on my borrower, even though we have the tax bill from the county in Arizona, but the lender's thinking they're going to reassess the value after we close the sale. But that's not how Arizona works. So again, more things to talk to your loan officer about and to talk to your realtor. Obviously, you guys, all of you viewers out there, you see Sam does real estate. She's a realtor. She's a phenomenal realtor. She knows a lot about this. Your loan officer may know a lot about this. This is where you want the best team. You want to talk to both the agent and the loan officer. Have them talk to each other. I mean, these are things that come up, like Nathan's saying. Nobody wants these types of surprises. So a little bit more inquiry up front goes a long way.
And one of the things that you said there, Tom, as you were talking about the early explanations, as Sam was going through Texas stuff, I'm no different than you guys. You probably hear all the time, someone went and they end up halfway through the transaction, they're super unhappy with their realtor, they're super unhappy with their lender. And you say, how can you avoid that? Well, you ask questions, kind of like we're throwing out here, and your professional should be able to answer them just like this. I mean, was there any doubt that Tom knows how impounds work? Was there any doubt that Sam knows how Texas work? I talk to people regularly, whether it's a realtor or a lender that someone kind of went down the wrong path with, and you're like, it should have taken a reasonably intelligent person about 2 minutes to know this person doesn't know what they're talking about. You might like them, they might be friendly, but this is not fun and games. This is very serious business. It's the biggest investment, the biggest debt you're going to make in your life. You want people like this who can answer your questions accurately, immediately, and in an expert fashion, and give you the guidance that you need. It's funny. I always tell people what we do isn't rocket science, and it's not, but it's very complex. All of these little issues you could teach a 10-year-old, but to know the hundreds of little issues that we need to know on both sides to keep people on track. And Tom, you brought up another really good point there. I'm in California. It's really easy to do loans in Arizona. It doesn't take a whole lot to get licensed, but there's some distinct differences. It's very similar, but it's very different. And very few people do more than just get their license in Arizona, or an Arizona person getting their license in California. They don't dive in and get the purchase agreement that is used in Arizona. So one of the things, Tom, again, not to get too far off topic of our impounds, I found out the hard way. I don't do loans in Arizona, but my aunt was selling her place in Havasu, and she tells me like 5 days before closing, oh, they're backing out, they don't qualify. I'm like, what are you talking about? The loan contingency should have been removed 2 weeks ago. Well, you guys contract in Arizona, it gives them till like 5 minutes before closing to have a loan contingency. So long way of saying things are similar everywhere, but enough different that it doesn't mean you have to use an Arizona lender if you're in Arizona, or a Texas lender if you're in Texas, or a California lender. But ask them how many deals they've done. Ask them how many purchases they've done. Ask them how well they know the little nuances and subtleties of doing it. If you're not committed to learning how each area is different, you probably shouldn't be willing to take commissions out of those areas.
And like Nathan, let's use Nathan's as an example. Again, regardless of the state, if a borrower asked me, Tom, do they reassess after the sale? And we're talking about a state that does reassess, and I say, nope, never heard of that. And then they do reassess. And then, like Nathan, their mortgage payments going up $400 a month. An equivalent on an average median price home, $400 a month is probably only almost 2 full percentage points on interest rate. So if you were to buy a home at 4%, but then all of a sudden your mortgage statement came and you're at 6% and the payment's going up $400 a month, you would be livid if your loan officer just rattled off an answer. That's a major concern. $400 a month is huge. So we want to narrow down these things. I like, just like the overlay thing, I will be very upfront and honest with the consumer, as any professional should, because again, this is the shelter over your family's head. This is not a TV you're buying at Walmart that you're not sure how long the warranty is on. These are major questions that you got to ask. And like Josh said, if you get a bad feeling in your gut, at least get a second opinion. I'm not saying drop whoever you're working with, but you need to at least get a second opinion. Like Josh said, you got to have that feeling deep down that if something doesn't seem right, they might be a phenomenal person, great agent, great loan officer. At least get a second opinion. There's nothing wrong with getting a second opinion. Then you will really start to see the difference, and you should ask as many questions as possible. This is the most expensive probably investment that any consumer will make. We want to make sure, and for any veteran or service member that earned this benefit, you deserve the right answer. You deserve someone, if they don't know, for them to say, I don't know, let me ask questions. If I had a relative in California and they asked me about reassessing, I would say, I don't know, let me go ask Josh. He's a loan officer in California, or a professional in California. That's our due diligence to do that for service members and veterans who've earned this benefit.
One of the big things that you just said there is, like, the worst thing that can happen is a shock 6, 8, 12 months down the line. Tom, do you want to walk us through? Lenders have to reconcile these impound accounts. at least every 12 months. Sometimes they do it on a 12-month cycle, so you may get the first one before 12 months. You want to walk us through what that looks like and how and why it can sometimes be an unpleasant shock for a recent buyer?
Yeah, I'll use myself as an example. My wife and I bought the home that we're currently in about 6 years ago. About 2 years ago, I got a tax bill. Wait, my taxes and insurance are impounded. I don't know why I'm getting a tax bill. The old Tom was just going to toss it aside and not pay attention to it. Well, the Tom that is now a loan officer called the county and said, "Hey, my lender should be paying this." I called my lender. They told me to call the county. The county did say, "Yeah, they're supposed to be paying it, but they haven't been paying it. You owe us for the last 6 months' taxes. We never received a check from your escrow account." Wait a minute. They took that money. Where's that money at? There was a breakdown on that. So if you get a tax bill in the mail and you did escrow your tax and insurance, don't just throw it to the side. Mistakes do happen. Things do fall through the cracks. And like Nathan said, you don't want to just not pay your taxes because the tax man will come take your property, and that'll not be a pleasant surprise. So as much as the payment increasing is not a nice surprise, neither is someone knocking on your door saying they want to seize your property for unpaid taxes or tax liens being put on, things like that. So you definitely want to do a little bit of extra work. If you get a tax bill in the mail, make sure and call the county. Make sure and call your lender. If those taxes are supposed to be escrowed, let's ask some extra questions. Let's make sure an accident didn't happen. Humans are evolved. Humans make mistakes. We want to find out. We don't want the owner of that home to be the one that suffers. We want to find out. So to go to Josh's question, as far as we were talking about how things are calculated, how those things are paid, sometimes you will find that there's the lender finds there's a shortage in your escrow account. So you might get a bill or them saying we need to reassess your escrow account because there is a shortage. Why might there be a shortage? Well, we're talking about property tax values increasing. Homes go up in value, always will, hopefully. So obviously taxes get more expensive, right? Well, if your mortgage payment is always X amount and that never changes, well, at some point the escrow account is going to be short for your property taxes. Your homeowner's insurance probably may increase every couple of years or every year also. Things get more expensive. We're dealing with inflation in this country right now. Things go up in price. Obviously, insurance is going to go up in price. Building materials go up in price. So same type of thing. Your insurance might have been $1,200 a year last year. Now this year, your insurance company might have recalculated it's going to be $1,450. At some point, your escrow account is going to be short. So your lender is going to send you a statement that says they need to amortize or recalculate your escrow account, and it's going to change your payment X amount. These are things that you want to talk with on your lender. You want to verify what was the change. Okay, was it taxes or insurance or both? And was that change correct? As Nathan's talking about with Sam, there's a lot of different things that go into, especially from state to state, property tax changes. Could be the sale of the property, could be a homestead expiration, it could be a number of different things or caps that are lifted on increases. These are things that you want to talk about. You want to verify that it's correct, number one. Number two, you want to understand, is the change going to be only for a certain period of time, or is that going to be moving forward? This is the change you should expect. If it's the change you should expect moving forward, when is there going to be another recalculation? Should you only expect it for the next year, or should you expect it for the remaining term on the loan? Or is this something that every time the tax or insurance gets recalculated, they're going to need to readjust your account? These are things that you want to ask your loan officer and your realtor. And if you're currently in a mortgage that the escrow account has a shortage, you want to ask your mortgage servicer. What the mortgage servicer is the person basically accepting your mortgage payment. When you get a statement online or in the mail, it's going to have a number for the mortgage servicer. This is not your loan officer's phone number. It's not your realtor's phone number. This is the person, the company that actually takes those payments. And they will have a department that calculates how much your escrow account needs and pays out yearly and annually for those taxes and those insurance. So you need to have that conversation with the servicer. You want to understand how this works. Again, do not, by all means, do not just sweep it under the rug. Do not avoid it, because things will build up and things will become a problem if they're just swept under the rug. So if you get that letter in the mail, call the servicer, understand how that works, understand what changed. Oh, your insurance went up $300 a year. Oh, maybe I need to shop for cheaper insurance. I'm going to call my insurance agent. What changed on my insurance that made it go up $300 a month? Oh, well, your other house burnt down, so we think you're a bigger risk. That's why we're raising your premium. Okay, maybe that's not going to be cheaper everywhere if I'm the one that the house burnt down on. So you want to have those discussions. Oh, well, the property tax is increasing. Make sure you talk to your county. Make sure you're talking with your realtor, your loan officer. See if there's some type of exemption. Honestly, I knew nothing about what Sam and Nathan are talking about homestead exemptions. I don't know what that is. But we don't have that in Arizona. So
Right.
that's a big thing. If I just happen to get licensed in Texas, there's no way I should be speaking with a borrower about these things because I don't know. So we want to ask those questions. Is there any types of exemptions? And understand, if you bought a house 5 years ago in a certain state that didn't have any type of exemption, it doesn't mean today, 5 years later, they still don't have any type of exemption. As we talked about, we and a lot of professionals are trying to get states to change some of their laws on these things. So it's a constant thing that you should be following up on every couple of years, at least see if there's any changes. You want to pay attention to these things. As Nathan was saying, depending on the month of the year that he bought his home, the exemption was different. It mattered what year he bought his home. Something applies differently now in 2022 than it did just a couple months earlier in 2021. So you want to find these things out. I know there's a lot. I know there's 50 states, but a little bit of legwork goes a long way and can save you thousands of dollars.
You know,
Josh, I want to hit.
Yeah.
Sorry. Well, make your thought, and then I want to hit a question on here because I'm going to ask Sam a direct question.
Absolutely. One of the things we're going to say, without going down the California specific rabbit hole over here, Glenn Groves, who was one of our guests, is not feeling well, so it wasn't able to join us. But in the chat earlier today, he had mentioned something we have unique to us in California. It's that because of Prop 13, our taxes are limited. They can only go up, your property taxes only go up 2% a year. So if you buy a home from someone who bought their home 20 years ago, their taxes are tiny relative to yours. So when we set up your loan, we're going to set it at what your assessed value is going to be, your purchase. Tom, kind of what you were talking about before is we get reassessed at sale. So we set it up properly. But let's say your servicer is one of the ones that they review every account every February. And February has only been 6 months, so you haven't been reassessed yet. They will often look at your impound account and say, whew, we got way too much money in here. Their property taxes are $150 a month. And they write you a check, and a homeowner not paying attention gets that check and goes, this is awesome. I have no idea where this $3,000 came from, but I'm going to Tahiti or Mexico or wherever. And then we come back 12 months later and they come back and they go, whoa, we don't know what happened, but you way underpaid your taxes. You owe us a ton of money, because not only did they refund you the money, they lowered the assessed value and what was expected to be collected. So someone here had earlier made a comment when we were talking saying Texas waiving escrows is fine. Many lenders allow it. I don't have an impound for escrows personally on my VA loan. Escrow mismanagement is real and can cause the same hardship or worse than managing the cost yourself. And a lot of people that don't have impounds choose not to have them, not because they don't like the convenience, but they're worried about silly errors like that. And why does it happen to people in California? Is because we're a high labor state. So most of the call centers and office cubicle farms that are doing that type of work are in another state. California is the only state that handles it that way. So it just confuses them and they go, well, this is how we do it, and they mess it up. So I certainly understand some people saying, you know what, I'll make that big tax bill payment twice a year just to avoid that. So just kind of wanted to throw it out there. And kind of the other last thing that we want to make sure everyone knows is the lender is allowed to have a pad in that impound account. So when they do that 12-month reconciliation, if your insurance went up a little bit, your taxes went up a little bit, their pad can go up a little bit. And maybe there was enough in your account in the last 12 months, but their pad's not what they're allowed by law to have. They're going to bump that pad back up. So it is incredibly rare if you have a home with an impound account on your mortgage that it's not adjusting, even if it's just a little bit every year. So it's something you should prepare and be aware of.
So I was going to bring this up, Sam. We had a question pop up, and I want to hand it to you first, and then I'm going to geek out on some compliance stuff real fast and quote some regulation. But I'm kind of curious what you're thinking here. So this person asked, if the property tax is paid in advance as part of the closing costs, why do we still pay them for the remainder of that year? Where is the extra money going?
Okay, so that question is a little confusing. I won't say confusing, but they're paid in advance up to the portion that has been paid for that year. So if only January 1st through June 30th has been paid, you still have June 30th through December that you, as the borrower, have to pay, because you have to equate to that full year's worth of taxes. Now, for those who have exemptions or full exemptions, the taxes will be assessed on the property based off of the current owner's ownership. So they're going to assess those taxes based off of the current owner, not you, the veteran that's exempt. So if they don't take the money and the city still comes back and says, hey, you still owe us this because this is what the taxes were for this previous year, you're going to be hurting. So that's kind of why. But where's the extra money going? There's no extra money. Legally, the lenders cannot keep any extra funds that you have given that has not been designated. So if you haven't designated for those funds to go to the principal, and you're not going to designate it to go to the interest, but if it hasn't been designated to go to the principal, taxes or insurance, that money has to be given back to you. So there's no extra money. The money, if you do have property taxes, is there to collect, to continue to pile up so it can be there for the next year's taxes.
Bingo. So what I wanted to quote to is, Vetted VA, one of the big things we do is try to equip anybody in here with answers to be their own best advocate with whomever they choose to work with. So one of the beautiful things about that is all escrow law is actually contained within the RESPA rules. It's statute 1024.1, well, 1024, specifically RESPA section 10, which is .17. I know it's confusing. RESPA being Real Estate Settlement Procedures Act. And in that, it lays out all the things that are due to you as a mortgage payer, and the things that the servicer, the company collecting your money and servicing and paying where that money goes for your monthly payment and collecting all that. Josh mentioned it, Sam mentioned it, and Tom's mentioned it. There will be extra, right? So your servicer at the time taxes are due can have a total of 14 months of tax payments in that account. They have to analyze that account once a year at minimum. Upon the time of settlement, and this kind of goes to answer the question that followed that one, Sam, which was, and Tom, I'm going to have you weigh in on this one a little bit. If the property taxes are paid in advance, oh, wrong one. That was the last question. Here's the question. I bought in September 2020, but just received a notice that my payment will be increasing by $500. Apparently my escrow is miscalculated at closing. Has anyone had this happen? Can I fight it? Yes, it's happened. I don't know that it was miscalculated, and here's why. So at the time we've talked about, the time of closing, what the title or escrow company or your closing attorney knew to be true was a certain tax amount. If the taxes changed, as they did in my consideration, and I'm already looking at a higher bill, I'm also going up that much, but it didn't mean anybody did wrong. What it meant was that the valuation changed, the new tax appraisal district was released, and now my taxes have gone up, and I will have to adjust so that I do not come up short. What's happened is that your servicer has done their annual due diligence recalculation on your escrow balances. And they've said, based on what we know to be true on the tax bill and what our balance is now, and solving for why by looking to the future, we're going to be short X amount of dollars. To make sure that doesn't happen, we have to adjust your payment by Y, $500 a month, to make sure that you have enough money in the account to pay your taxes, plus a small margin, no more than 2 months of their calculation, above and beyond what they think that bill will be. That is actually all called out in statute 1024. If you're ever curious about what your rights and regulations are, you actually have the right to contact your servicer, like Tom has said, and within 30 days, they have to come back with a calculation and tell you and balance it and say, here's your report, here's our last tax bill, here's how much is in the account, here's how much we think we're going to need, and if there's any excess over 2 months of holding, they send you a check back. To Josh's point, hold on to that check. Don't go celebrate and just go pay off a whole bunch of stuff or go buy the new pool like Christmas vacation, right? This isn't your bonus check that we're going to go buy a pool for the family. You need to hold on a second, because errors can still happen. And so these are key components to the whole thing. You're looking at Regulation X. It's part of RESPA. and it is covered in 1024.17. So good stuff.
We had a couple of other good questions in there too, Nathan. If you wanted to throw up, I will volunteer to take the one there on supplemental taxes, since the other 49 states are going to look at us like you're crazy. What's a supplemental tax? So it kind of goes back to in California. Think you muted yourself, Nathan.
And I turned my camera off. Man, it's like a novice day. No, I was just going to say supplemental tax. I keep thinking they're just taxing all the medicine you take down there in California. Like supplemental tax.
It's a funny quirk of Prop 13, which again, Prop 13 states that once you buy your home, it's assessed at the purchase price. It can only go up 2% per year. So we don't get reassessed immediately upon sale. So let's say that you bought someone's sweet grandma's home that they paid $30,000 for, and it's only assessed at $50,000 now. You buy that house for $750,000. You have $700,000 of unassessed value. You're going to be paying property taxes at the rate of the previous owner until somewhere in the next 12 months, the assessor's office gets around to reassessing it. The supplemental bill is simply an additional tax bill, one time, it's not recurring, that accounts for what was not collected because you were paying at the lower rate. Now, again, because the people that are the servicers and the call center they have that you can call and talk to, they're familiar with the other 49 states, and California is the only one with a goofy law like Prop 13 and supplemental tax bills. If you call them and ask them to pay your supplemental tax bill, they're going to tell you we can't do that. You're probably going to need to get a supervisor and say, please, I need you to pay my supplemental tax bill. And the reason why they can do that is when we do your loan, we are looking at what your tax bill is going to be and setting up your monthly payment. Because when we're underwriting, we can't say, hey, you qualified with grandma's $75 a month tax bill. We have to say you have to qualify at your $600 a month tax bill. So that's what's going into the impound account, and they can pay it for you, assuming they haven't done what we talked about earlier that Glenn had brought up, refund you this mass excess that you have in your impound account. So hopefully your supplemental bill comes fairly soon. Hopefully your assessor, your servicer understands that you've been paying at the higher rate and they can cover it. But that first year in California can be goofy until things even out, unless you bought from someone who recently bought a year or two ago. But with our rapid appreciation, even that can be off a big chunk. And for those of you in the other 49 states, I apologize that you had to listen to that.
Something I always hear too, that we talk about reassessment after sale, and we're talking about existing homes. What about a new build? I'm actually doing a VA loan on a new build, and I actually had this discussion with the veteran and their family this morning. Hey, you're buying this home, and even though taxes are cheap in Arizona, a $600,000 house doesn't have $104 a month in property taxes. That's your land is assessed a tax rate. I want you to understand that this is going to be recalculated. And while we're not going to just guess at what that number is, you're going to sign what's called a shock letter at closing, which says your payment is going to go up significantly when the county in Arizona recalculates those taxes, because now there's a home built on that empty land that they had just assessed as vacant land prior. So that's a very important thing. You want to have that discussion. While I'm having this talk with the veteran and their family about what the interest rate and the payment is, I wanted to bring to their knowledge that the payment is going to increase significantly once that is reassessed. Now, it's not going to go to $12,000 a year like some states, but it is going to go up considerably from the current $1,200 a year that the tax is assessed. So that's another thing to have a discussion with, regardless of the state that you're in. You want to talk to your loan officer and your agent about, hey, what is going to change? We also talk about homeowners, HOA, homeowners associations, and how that plays into escrow. But taxes, we're talking about taxes are changing. It's a brand new home. That structure probably has not been assessed for the full value. It's probably just assessed on vacant land. So make sure you have the discussion. I know Josh and Nathan and Sam, we were talking about homeowners association fees earlier. Josh, were we going to go into, we have some questions on that we want to talk about as well?
We just wanted to cover, is that included? Because again, the way the new loan estimate and closing disclosure, it shows it and you're seeing it. And I'm sure you get the same question, just like I do all the time. Whoa, I don't pay my HOA in the monthly payment. Why is it shown in there? And if you look at it, it can be confusing. It does look like it's included, but it's not. But why don't you walk us through how HOAs impact or don't impact your impounds?
Yeah, and so again, the same situation I'm dealing with this morning. There are some homeowners association fees that are included in the closing costs, like a transfer fee, a community improvement fee, a couple $100 here and there for these fees. And then on the first page of the loan estimate, it shows my principal and interest payment. Then it shows my payment including escrow. It's going to show check mark for taxes, check mark for homeowners insurance. But then the next section down, it says what is not included is your homeowners association dues. And then it shows with that fee included how much you're additionally paying. And the reason why is exactly what Josh and Nathan were saying is, we used to just kind of sweep it under the rug. And sometimes we would people would maybe try to be dishonest with the borrowers. This all needs to be outlined because certainly every state's different, every community is different. There are locations in Arizona where the homeowners association fee is $400 or $500 a month. And so while that's not included in your mortgage payment, you want to know that you're going to have to pay an additional $500 a month or however much it is per month. You want to know those things. Some retirement communities in Arizona, the community improvement fees are $3,000, $4,000, $5,000 a year, or when you buy the home. That's in your closing costs. That's on the loan estimate. But you want to find out is, like Josh was talking about, is this a reoccurring fee? Do I pay $4,000 a year for the community center? Or is that just a one-time fee when I buy the home? You want to have this discussion. The homeowners association dues could be collected monthly, quarterly, semi-annually. They could be collected annually. You want to know that as well. $100 a month doesn't sound bad, but if you got to pay it once a year, like your homeowner's insurance, and you get a bill for $1,200 randomly, that's for your homeowners association. You want to know that, because if you don't pay that, they're going to come for the property or put a lien on it as well. So you want to make sure and have that discussion with not only your agent, but your loan officer. The agent's going to know a lot more particulars about the property, but the agent is also going to talk with the loan officer, as you should, as the borrower should, about how all that lays out into the mortgage. What's included in my closing costs? Are those community improvement fees included in my closing costs? What do I pay separately? Do I pay it monthly? Do I pay it quarterly? Do I pay it annually? Again, asking questions. You want to understand how all this works, because again, my friend Bob bought in a similar neighborhood in Arizona, but it's completely different homeowners association, completely different billing situation. So it's not going to be the same. You want to have that discussion.
So we have another question here. I think it's going to be slightly different answers for all three of us. So I kind of would like us all to take a shot at it here. So is it normal to pay 6 months or more of property taxes or Melloroos at closing? So Sam, you've already gone through this a little bit, but why don't you walk us through what does it look like? What do they pay at closing if it closes in March versus September, and how it varies in Texas if it does?
It does. So a lot of times, if you're closing at the end of the year, you kind of get away with not having to bring as much property taxes to the table, because the seller is going to be responsible for all of those property taxes, and the bill should have been sent out by then, and they should know exactly what the tax amount is. So you get a little advantage closing at the end of the year than you do at the beginning of the year, because you have more taxes that you're going to have to bring to the table. On average, I see anywhere between 3 to 6 months of property taxes being paid out from a borrower in the state of Texas.
And with that, you had said earlier, this is really a question for my edification. So you said they're paid in arrears. So we get to the end of the year, you've accrued your taxes, and then the tax bill is paid. Am I understanding that correct?
Yes. Mm-hmm.
So what happens on the loan side, and I know you don't do loans, but you do a lot of transactions. You see this, if we close in March, are they collecting? So if we close in March, you don't have a March payment, you don't have an April payment, you have a May 1 first payment. So in that instance, you have 7 payments before that property tax bill comes due at the beginning of the year. Do they collect like the 5 months prepaid so that you add the 7 and it gets paid? Or was that portion already taken and prorated out to the seller because they used the first 4 or 5 months of the year?
If that they will always charge the seller from the date of the beginning of the year to the date of closing. Anything after closing in the state of Texas is borrower responsibility, no matter whether they're disabled or not, because the state of Texas is going. So we just paid our 2021 taxes in 2022 for 2021. So they're going to pay whatever the amount is from closing to the end of the year. The borrower and the seller is only going to be responsible from January 1st to the date of closing. So yeah, they're not going to take, I haven't typically on my manual underwrites with these lenders is where I see the majority of the taxes being taken up front, where they'll go into a 6, 7, sometimes 9-month property tax requirement. More so than the ones that don't have to do a manual underwrite. But on average, you'll see 3 to 6. I see more 3 months than 6. But on my manual underwrites, I have seen as far as 7, 9 months one time because in Texas, if you don't pay your property taxes, and I'm sure it's like this in many places, they'll take your property. If you don't pay your HOA, they're gonna put a lien on it. They can foreclose on the property and sell it off to somebody else. So they're real strict on our property taxes and how it's paid out.
So Tom, for you in Arizona, did you say you guys pay the taxes twice a year, or is it also one you pay twice?
Twice a year.
So is it consistent every 6 months, and how does that impact what a buyer should be looking at paying at closing?
Yeah, so good question. It's every 6 months, March and October for a lot of the counties in Arizona. Every county can be a little bit different because of the county that dictates it. But for the majority of counties that I have dealt with, it's March and October. It is twice a year. And again, this can vary depending on, like Sam was talking about, depending on what month you're buying the home. The taxes are paid up until you taking possession of the home. So the date that you close on that home, now you're paying the property taxes moving forward. So it's calculated based on your time of ownership. So if we're closing a home in March, and March 1st is when it closes, now you're taking ownership of that property. Come October, you're going to have the full tax bill that's due. But again, this can change depending on the time of the month that you close. And again, I've dealt with situations where we move closing up. I just did one a couple days ago. We've dealt with one where we've pushed closing to the next month. So now those closing costs are going to change because they're going to recalculate. Might be higher or might be lower. So these are questions that you want to talk with your loan officer. Why did my numbers change? Why am I paying more taxes now? Why am I paying less taxes now? Don't just assume, oh my gosh, they're just raising my fees or they're lowering my fees. They're giving me a discount. Again, when I go through loan disclosures, loan estimates with consumers, I explain what may and may not change. I explain why something may change. And then if it does change, I walk my consumers through that. But let's just be honest, that doesn't always happen. And sometimes it's not explained well or it's not understood well. And so these are things that you want to have a discussion, especially you could be moving states, you could be buying versus you've only refinanced in the past. So why is there a full year of insurance being charged where when I did my refinance, it was only a couple months? Same thing with taxes. Gosh, if I moved to Texas and they hit me with a year's tax bill, I'd be like, what is up with this? But I don't know. I don't live there. If I was just moving there, unfortunately, like Nathan, I'm going to be dealt some surprises. So it's important to have that conversation, understand how that works, understand that the taxes are paid up until that point. I've had transactions where the buyer is buying a home where the taxes are not paid in full by the previous owner. So that can come up also. Mm-hmm. The title company is going to do their due diligence on that. I've had situations where we're doing a refinance and there's a lien on the property because the Homeowners Association dues were not paid. I just did one. $4,800 was due to the Homeowners Association. The good news is, luckily we found out about this because they actually filed for foreclosure to take possession of the home because there was $5,000 due, a couple of years worth of Homeowners Association fees. But again, the borrower wasn't aware of this, or so they say. They had some medical situations. They were in the hospital for 6 months. So they probably, some things just fell through the cracks. Luckily, we caught that. But like Nathan said, Sam said, I said, Josh, you said, we don't want the knock on the door where they're going to take possession of the home or put a big lien on the home. You want to have these discussions. You want to understand why the taxes may be different, whether it's state to state or transaction to transaction.
I think the big takeaway from what the two of you just said and a lot of the discussion here, homeowners insurance is pretty simple. It doesn't change that much from year to year. It is what it is. The property taxes, a lot of the questions that we get in the forum as moderators and are meant to ask are people that are upset that they're getting a different number or an answer that doesn't make sense. What you should be able to see by now is that the property tax stuff is complex. I'll throw in the joys of California on top of it for you. Our taxes are due twice a year, but you would think that a rational government would say that would mean every 6 months. The California government does not do it rationally. We get them paid in November and February, and it gets better. The November is delinquent in December, so hardly anyone pays them before December. But the February isn't delinquent until April, 2 months later. So with that, if I show you, we have a chart we have to go to. We build it into all of our software. I mean, I can memorize 12 different months, but every month is a different amount of prepaid taxes that you would collect because we have this goofy schedule of when they come in. So it could be that you have an inexperienced loan officer that doesn't know what they're doing. It could be that this is really complex. I would say, I mean, Tom, I don't know, and Sam, you see a lot of estimates from lenders. This is probably the area where we see most variation from beginning to end, because the other stuff is fairly simple. We reach out to third parties, escrow, title. What are your fees? We gather that. We know if there's an admin fee or an underwriting fee. We know what an appraisal is going to cost. This stuff, depending on where you're at, can be a little goofy and crazy. So if you guys playing at home and asking these questions are wondering, why doesn't anyone tell me this, or how is it hard to get a straight answer, it can require some digging. And it just posting something in a forum, it's hard for us to determine what the accurate answer is, even though with some digging and asking a few questions, you can get to it, but it varies state by state, time of year, and it's a tough one. So it's not that anyone's trying to take advantage of you.
And we've seen it, like we were talking about earlier. Sam and I were talking about, one member said, hey, this lender told me this, my friend's lender is saying something different. Same thing. If you talk to your agent and your agent tells you one thing and the loan officer tells you a different thing, ask them both to hop on a call together. Let's do a 3-way call. Like if Sam and I, if she was the realtor on a transaction, I'm the loan officer, she's part of the team. Like we're on a team. The only thing that matters is getting those borrowers in that home safely and happy and as least stress as possible. Like we work for those borrowers. Like that's our job. So like I would love to hop on a call with the agent and have a discussion with the consumers, make sure the consumer understands everything, make sure I understand everything properly, the agent understands everything properly. Ask them both to hop on the call. They're both working for you. That's your team, including the title company. If you have questions about title, ask them to hop on a call together. There's nothing wrong with that. You want to get everything out. You want to make sure everybody understands and your questions are getting answered and you're not getting maybe one answer from one and maybe a different answer from the other party. Get them all on the same call. Have a discussion with them. Make sure you understand.
It's funny, of all, this is again the 7th episode of Vetted VA Live. We cover a big topic, and I feel like with the other 6 topics, we were kind of able to get to the end and wrap it up with a bow. And this one is a little more open-ended and crazy, and largely because of the property taxes and how different states handle them and how they vary by different months of the year. With that, we've been going for an hour and 15 minutes. We've answered a bunch of questions. Sam, is there anything that you would like to close it out with, information that you would like the viewers to know, maybe that you share with your buyers, your sellers, what they need to be aware of in this process?
I think Nathan had a question. I seen him raise his hand.
No, you go first, Sam. I'll hit it. I'll hit my point.
Okay. Well, in the state of Texas, we have what's called pit tax, mud tax. So definitely be aware of those taxes. And that's an additional tax that is not, typically they don't include it in the the escrow account is a separate charge. So it's similar to a HOA. Some of it's paid monthly, some of it's paid once a year. So just be very well aware of that. Just make sure that you're getting those tax statements ahead of time. Know the tax rate in your county. Here in Texas, they vary every city. So just be very aware of the tax rate that you're going to be charged. If you have any exemptions available to you, definitely take advantage of those to save you some money. Yeah.
Before I throw it over to Tom, Nathan, did you have some more you wanted to put in?
Yeah, I was just going to bring up for my last point. We talked a ton about taxes. We talked about some HOA stuff. Remember that escrows are set up to help prevent from liens being placed on the property that would supersede the lien that's held by your mortgager. Right, so your lender has a lien on the property, and they want to keep HOAs and cities and counties and states from being able to say, no, we get that property because they didn't pay this one thing before, right? So there is some impact there. The other thing is that tons of topics on taxes. Don't forget your insurance. If you are just hanging out with the same insurance company because it's just one simple check to write, knock it off. Get out there and shop your insurance annually, if not at least every other year. Because if you've never had a claim on your house, but maybe you had a claim on your car, that can affect the entirety of it. So get out there and make a change. If you've never had a claim, see what other insurance companies are out there and what they're doing. I wouldn't just stay with the big ones. I'd find a local, like seriously go to the Chamber of Commerce and find a local insurance broker that's at your chamber and say, hey, here's my property and I'm looking for some new property insurance. They will handle this stuff for you, but get a feel for what that is in your current policy. Make sure that you hand that over to your current insurance or a new insurance provider to make an assessment on. Know your area, because it's strange how insurance can change. It's boiling the frog a little bit. It just changes, and you're just like, well, the worst change was the taxes, so I'm going to look over here. But meanwhile, insurance is just kind of going up and up and up too. And you're like, well, I didn't even have a claim, so why is my insurance going up? So shop it. That's just a really big takeaway, and don't always believe the sales pitch that having all of your stuff bundled together makes it cheaper for you. That's not always the case, especially when you have kids that start to drive.
I love the idea, Nathan, you said of having a broker kind of do a review on it, because you're with one, and if you want to call 3 different insurance companies, you can do that. Or
you won't save money, by the way. That's not how insurance works. You
could take your policy and send it to a broker and say, do you have of any of the 8 or 10 or 20 insurance companies that can do better? And they can often tell you what's the trade-offs, because there are trade-offs. All insurance companies are not the same. And Nathan, you also said another thing that was just super important. Why do lenders prefer that you have an impound account? We talked about some lenders have overlays that just require them. Some of them will give you better terms if you will take them, and you spelled it out in perfect terms. They want to protect the security of their loan, and they've found when your taxes and insurance are included in the monthly payment, they get paid more often and they result in less problems for the lender. So there's no grand scheme. I get people a lot that will say, well, they just want my money because they're going to make interest off of it. And like, well, they're not off investing it in crypto. I mean, they're sitting there in a very low yield account if there's any yield. So really, it is just the security of knowing that they're paid. So with that, we want to leave Tom here with the last words of wisdom on escrow impound accounts. Do you have any words of wisdom you want to share with us, Tom, before we close out?
Josh, you were breaking up a little bit. I think it's when your lights went off. I'm just kidding, but I hear you now. But I think Tom froze. Perfect. So we hit that time. It's like put more questions.
My internet was slowing down a little bit.
Oh, there he is. Tom's back.
Yeah. I thought you just decided, I am tired of this guy, I'm tuning him out. And Nathan says, no, my mic went out. We're having all sorts of technical difficulties here at the end of the show.
Yep. I think we lost Tom. Well, I appreciate it, man. And it's, wait, there he is. I see him moving now. You're back, Tom.
Are we good? Okay. Words of wisdom. Obviously, everything that we've talked about, talking to your agent, and obviously, not taking the first offer, whether it's your insurance or whether it's talking with a lender, not getting straight answers. You definitely want to shop around. You definitely want to look into things. Claim policy. How does their claim policy work? How do they handle claims? Will definitely help out. So that's really all that I had. Thank you guys for joining us.
No, thank you too for joining us and the words of wisdom, going super deep on Texas and Texas properties, property taxes, and Tom, a lot of the insights there to Arizona. I think it's Nathan's influence. He steered the conversation towards his Texas property tax issues, but it's
personal.
It's
a personal thing now.
Well, it's a good one, and it's a pertinent one. Like you guys said,
Yeah.
Lots of people moving to Texas, lots of people moving to Arizona. So a good discussion. Hopefully you at home found it helpful. We will be back next week with another topic and another group of experts to share their wisdom.
Awesome.
All
Thanks,
right,
everybody. Thanks, Sam. Thanks, Tom.
Have a good night.